Having $10,000 in savings is a significant milestone. However, deciding what to do with this sum can be daunting. Making wise financial decisions now can lay the groundwork for a secure future and help you avoid regret down the line. While this might not seem like a life-changing sum of money, if invested properly over time, it could grow to become a very substantial amount. Let's explore some prudent options for maximizing your $10,000. Before embarking on any investment journey, it's crucial to establish clear and personalized investment objectives. These objectives serve as guiding principles, helping you align your investments with your financial goals, risk tolerance, and aspirations. Is it for a rainy day fund, clearing debt, or is it money for making major life changes? By clearly outlining what you aim to achieve, understanding your risk appetite, and aligning investments with your objectives, you pave the way for a strategic and purpose-driven investment approach. Open an IRA. Bolstering your retirement savings is an excellent use of $10,000. If you don't have one, consider opening and funding an individual retirement account, IRA. An IRA is your go-to choice if you don't have a 401k plan at work. It's also a great option if you want better investment options than you get with your workplace retirement plan. The best IRA accounts let you choose from a broad range of asset classes, giving you more flexibility. Another strategy to consider is a Roth IRA. Contributing to a traditional IRA gives you an upfront tax deduction, while a Roth IRA provides tax-free retirement withdrawals. Plus, you get more flexibility in making withdrawals before reaching retirement age. In 2022, you can contribute up to $6,000 per year into an IRA or $7,000 per year if you are 50 or older. Maxing out your contributions can help keep you on track to reach your retirement goals and possibly leave you with a few $1,000s to invest in some of the ideas below. Invest in mutual funds and ETFs. Mutual funds and exchange-traded funds, ETFs, are investment options that make investing easy. The best funds charge minimal fees and are pooled investment vehicles that own portfolios of stocks or bonds. They aim to achieve specific goals like investing in a particular market sector, generating cash flow, tracking the price of a commodity like gold, or emulating the performance of a market index like the S&P 500. As a regular investor, you can buy shares of any funds. The management team of each fund handles the hard work of keeping the portfolio on track. In exchange for this convenience, funds charge an annual expense ratio as a percentage of your total investment. You can buy mutual funds and ETFs using a brokerage account or an IRA. Vanguard is widely recognized as a leading provider of both types of funds. The power of compounding makes early contributions valuable, setting the stage for a comfortable retirement. Build a stock portfolio. Buying individual stocks is riskier than investing in mutual funds and ETFs. But for self-directed investors who want to take the time to learn about public companies and do the research, this could be a great way to invest $10,000. As you consider your options and research stocks, remember the importance of diversification. In a word, don't put all your eggs in one basket. No matter how much you like a particular stock or company, you should never buy $10,000 worth of a single stock. Instead, build an equity portfolio with a mix of different individual stocks, preferably ones that offset each other's risks. For example, if you invest in an oil company, which you do well if the price of oil goes up, also purchase an airline stock, which you do well if the price of oil goes down. Diversification spreads risk and potentially yield higher returns over time. Invest in bonds. Bonds could be a valuable investment for $10,000 if you want to generate income. When you buy bonds, you lend money to a company or government. You agree to hold on to the bond for some time, and at the end of this term, the bond issuer will give you your money back. In the interim, the issuer periodically pays you interest at a set rate. Remember, it's not impossible to lose money investing in bonds. If you want to sell your bond before the end of its term, you could find a buyer in the secondary market, but you might have to accept a lower price than you paid, depending on market conditions. In addition, if the bond issuer ran into financial trouble, they could miss payments or even default on returning your principal investment. Bonds with higher interest rates, junk bonds, tend to be riskier. Like any investment, there's always a trade-off between more significant risks and higher rewards. You can buy bonds through most brokerage platforms that offer stocks. Buy real estate with REITs. In today's real estate market, $10,000 is not enough to buy property. However, there are other ways to invest in real estate. One of these is through real estate investment trusts, REITs, publicly traded companies that invest in different properties. Most REITs focus on a specific type of real estate, such as residential or commercial properties. Some own multiple types of properties. To qualify as a REIT, companies must distribute at least 90% of their taxable income to shareholders, making REITs a good income source. REITs are similar to regular stocks and are highly liquid, which makes it easy to sell your investment and move your money elsewhere. This is different from owning physical real estate, which takes a long time and can be expensive to sell. Investing is a long game. No matter which assets you buy with your investment, your job is to remain focused on the future. If you can earn a 10% return on your investment every year for 30 years, your $10,000 could grow to as much as $174,000 without contributing another penny on top of your original investment. That's the magic of compound interest. On the other hand, if you kept $10,000 in cash in 30 years, all you would have is $10,000. And after the impact of inflation, the purchasing power of your $10,000 will be much less than it is today. To avoid knee-jerk reactions to market dips, know the risks inherent in investing in different assets before you buy them. Stocks are typically considered riskier investments than bonds, for instance. But even within the category of stocks, some investments are riskier than others. For example, U.S. stocks are considered safer than stocks from countries with still developing economies because of the usually more significant economic and political uncertainties in those regions. Bonds can be less risky, but they're not 100% safe. For example, corporate bonds are only as secure as the issuer's bottom line. If the firm goes bankrupt, it may not be able to repay its debts, and bondholders would have to take the loss. You should invest in bonds from companies with high credit ratings to minimize this default risk. Assessing risk is more complex than looking at credit ratings. However, investors must also consider the risk tolerance, or how much risk they can stomach. Even though they've committed to sticking with your investing strategy, you must check in periodically and adjust. When you check up on your portfolio, you want to ensure your allocations are still on target. In hot markets, stocks might quickly outgrow their intended portion of your portfolio, for example, and need to be pared back. If you don't update your holdings, you might take on more or less risk with your money than you intend, which carries its own risks. That's why regular rebalancing is essential to sticking with your strategy. Overall, investing is all about focusing on your financial goals and ignoring the busybody nature of the markets and the media that covers them. That means buying and holding for the long haul, regardless of any news that might move you to try and time the market. Making decisions with $10,000 in savings necessitates careful consideration of your financial goals and risk tolerance. While this sum may seem substantial, it's essential to weigh the potential returns against associated risks. Avoiding regret involves striking a balance between short-term needs and long-term financial security. Thanks for watching, and see you next time.